Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are bringing to you a new company, a new IPO, which is very soon going to get listed on the bourses. This company is catering. It's an ancillary company. It's a component company. Makes forged components, precision components. Is actually serving defense, aerospace industry, energy industry, oil and gas industry. Has marquee clients across the world, from US to Europe to India, has been serving quite a number of listed clients. Let me now welcome the management and also announce the name of the company, Azad Engineering Limited. And joining us on the show today is Mr. Vishnu Malpani, the whole-time director of the company. Vishnuji, welcome to the show.
Thank you, Piyush. Thank you so much for giving us an opportunity to be here. I'm very happy on the behalf of the company to be present here. Thank you so much.
And now let's start from the perspective of what actually company really makes and does. As I understand, it's about forged components, precision components, and the industries which you are serving, they all are sunrise industry. For the last almost 5 to 10 years, there have been many winners, a lot of new orders. Most of the companies, the new age companies which are coming, they have multi-year order books. So I think it's very exciting to know more now from you. So help us understand what the company makes, how it makes revenue.
Sure. Thank you, Piyush. I think very interestingly put, but I'd like to maybe start from the beginning. So I think Azad Engineering is a critical parts manufacturer. We make parts that are life critical and which are project critical or mission critical. When I say life critical, what do I mean by it? So we are a part, like you rightly said, we are a part of the energy industry. We also play a part in the aerospace and defense and also in oil and gas. Now, each of these sectors, you can make various kinds of parts and be a part of that industry, but we make parts that are highly critical, engineered and rotating parts. It's like saying, you're making a part which is going in an engine that's running at 30,000 feet. So that's the kind of engine parts that we make. So today, these are the parts that we make, and these are the industries. And we work with over, all the marquee names that you can find in this industry. We are working pretty much with them, and we export to over 15 countries today. Our revenue, 80% is derived out of exports. In terms of our manufacturing plants, we have four manufacturing plants which are based out of Hyderabad, around 20,000 square meters, and we have two large pipeline plants that are in the pipeline that are coming up, which will add about 8 to 9x capacity in the coming years. So for us, in the energy industry today, G Mitsubishi and Siemens, these are the clients that take about 70% of the entire industry. Now we are a global player in their supply chain. We work as a tier one with them, and we've been working for the last about average about 10 years, and we make one of the most complex products in the compressor section of a turbine. So we make parts for turbine which are land based, aero based, and space based, and these are extremely mission critical and life critical parts. So in terms of
I'm just jumping
yeah.
in between and then again give it back to you. So when you're saying turbines, these turbines would be getting used in which type of sort of end products?
So basically, turbine usually is an engine. It is essentially, it converts energy into one from to the other. Say for example, the land-based turbines that are there. So the electricity which is there in your studio, in my office, and around the world is generated out of turbines running in utility-based plants. So we
Right.
make parts for those turbines. There are also turbines that, so aircrafts have two engines, which actually are turbines, which give them a thrust to go up, right? So those are also turbines. Then in rockets, you also see turbines, which gives them, the thrust to go up to the space.
Boosters.
In oil
Yes.
and gas, also there are turbines that help you, do, the drilling, etc., etc. So turbines are used in various forms. So
So
what
anywhere where actually energy is being used, whether it's aircraft, rockets, or oil and gas or energy plants, those critical components your company is making.
Correct. So we are making that. So in fact, if I have to tell you, globally, 65% of the electricity is generated out of gas-based turbines, nuclear-based turbines, steam-based turbines, and combined cycle turbines, etc. So these are all turbines or hydrogen-based turbines for that matter. Now,
Hmm.
Azad Engineering has capability to make extremely critical parts for all of these kinds of turbines. So whether you look at it from a capability perspective, and this industry that we are in, Piyush, is a long gestation industry, because these parts are very, very difficult to sort of get qualified. So, typically a player takes anywhere between 3 to 4 years from the start to even get to a customer and then start producing these parts. So, over the last 15 odd years, what we have done is finished a lot of these qualifications. And now we are at a point where, we are a part, like you've said, on a high growth curve. So, that's what we are at. So, whether it is hydrogen based turbine, nuclear based turbine, gas based turbine, or steam based turbine, we have capability across all of them. And we are also manufacturing parts for aero turbines right now. So that's
So if suppose it is possible, then can you name some marquee clients which you're serving?
PUG. I mean, I would be more than happy to share it, but I'm bound by some certain restrictions. So I'll be
No
able to share. So we do have a lot of clients, to be honest. But in the end, while we were trying to get consent, we could get consent only for a few of them. So I'll name those few.
sure.
So we work with G, Mitsubishi, and Siemens on the energy side. On the aero side, along with other customers, we work with Honeywell and Eaton, and a set of domestic customers. But I can tell you, we work out of the 6 out of the top 9 clients in the aerospace sector as well. So that's something that we do.
Absolutely sounds good, because that also actually will tell our viewers in terms of quality of revenue predictability.
Yeah.
Please go ahead in terms of your other products. I interrupted in between. Please go ahead.
No, no, no problem. So Piyush, I would just like to reiterate the fact that our business is a very, very stable and is a part of industries that are high growth industries, like you said. So today, the parts that we are manufacturing in this industry, or the fuels that we are, gas, hydrogen, nuclear, etc. This is a $3.5 billion market for us. So the addressable market in energy is about 3.5 billion. For the parts that we've qualified for our OEMs, our global OEMs, we have about $12 billion market, and for oil and gas it's a $1.5 billion. So if you look at in total, we are addressing a total market of roughly 22 billion plus, in each of these sectors, and we have qualified 1400 parts across these sectors. So our business positioning today is that we work with the top tier customers which are global in nature, which control these sectors, and we also make the most critical parts for them, and that would also be reflected in our financials. So if you look at our financials, we've grown from 122 crores in FY21 to about 251 crores last year.
Hmm.
And
Yeah.
in terms of our PAT, we moved from 37 crores to about approximately about 80 crores last year. This year, H1, we've already delivered 100 and, approximately 160 crores. And we've done an EBITDA at 33.3% to about 52 odd crores. So what I'm trying to tell you is that this industry works on a J curve sort of a phenomena, where you spend a lot of time onboarding a customer, qualifying, getting certified by all the processes, and then over time, then you start manufacturing these products. So we've crossed pretty much all of these hurdles. That's why you can see a CAGR of roughly 40 odd percent in our top line and 40 odd percent in our EBITDA margins as well.
Right, and I'm tempted to ask you actually, whenever products actually are made in projects which are, the products are going to last for many many years, and so you have first supplied those components of those products and supplied and then garnered initial revenue, but then also some maintenance or service revenue also comes for some particular products. In your category also, is there any AMC or any service revenue or any maintenance revenue which is associated for long-term contracts?
So obviously this industry, you're absolutely right, Pujit. This industry is run by long-term contracts. So typically how
Mm.
this works in an industry. So the large global OEMs will have long-term contracts, because this is not an industry where a short-term focus is there. So generally when OEMs are working with their suppliers, they work on longer-term basis, because there are few players because at the top of the pyramid, and these players have been there for decades. So Azad is the earliest entrant. So we've been here for close to 15 years only. So these long-term contracts are with customers, and then for the 3, 6, and 9 months, you keep getting purchase orders on a rolling basis. So what happens is these long contracts then derive purchase orders, and these are coming to you. Now, if you look at how Azad has been growing, so in terms of our service revenue, etc., totally, if you look at the steam-based turbine installed base, right, it's about 2000 gigawatt across the world. 1800 to 1900 gigawatt of gas turbines are installed. Roughly around 400 gigawatt of nuclear turbines are installed. Now, there are two growth factors that are coming to this. One is the new builds that are coming in each sector. New turbines across the world are getting added. Plus, at the same time, this huge capacity that's been built has a lot of revenue that comes out. And this reflects in our customers' revenues as well. So our customers also do over 30%, 35% new builds and about 65% service. And they are sitting on 5 times the order book or backlogs on them, and which eventually gets reflected in our order books as well.
So, does that imply that you also actually have a service revenue component here?
So if you look at our RHP, there is obviously a service revenue that is there. That is the revenue that we do for one of our clients, which is Mitsubishi.
And how much
Right.
how much percentage is it of the total revenue at
So
present? It has to be small because it is
no,
growing right. But
no,
I'm just
so
looking at the long-term picture.
No, no. So we don't understand. For example, we manufacture critical components, right? So when
Okay.
an order comes to us, we wouldn't. So we manufacture compressor airfoils, right? Now, if suppose that part, the order comes to us from a customer, we don't generally get to know whether it's a service order or a new build order. For us, it's a because we are a strict build to print company, and the customer would just give us this order, and it comes to us. But if you're asking about the service revenue, which is there in our RHP, so that is the revenue that we do for our customers where the raw material is supplied by them. That is a
I
way of right. So that's
I
there. But otherwise, it's manufacturing where the scope of raw material is with the customer. Yeah.
understood. So basically, it's
So
100% manufacturing
yeah, yeah.
revenue.
So correct. So that's correct. So about 90% of our revenue is energy today. About 10% is aerospace, and oil and gas is in qualification stage for us.
Sure. Sounds great. I think your EBITDA growth basically is telling the entire story. The first 6 months of this year, actually, already the EBITDA is around 52 CR versus 72 CR last year. So that actually, in effect, is telling that already the growth is very strong. From that perspective, how much sort of pricing power do you have, or basically this is something because raw material prices also would be moving up and down. Is there a raw material pass through price embedded in your contract, like how it works for you on a pricing front?
So Piyush, I think this industry, like I said, is a very, very high entry barrier driven industry, right? No player can control this industry, and this
Yes.
energy is controlled by a few customers. So
Sure.
they regulate this entire thing. So you're right. So like we are a qualified supplier to them, we are also told by our customers to source raw material, from approved sources only. So we cannot
Okay.
obviously go out there in the market and look at sourcing raw material domestically. Majority of our raw material is imported and from OEM approved sources. But
Okay.
we don't control the price. We have in our contracts a plus minus 5%, right? So if the raw material price fluctuation is over plus minus 5% or around that region, it is obviously, if it is in that, then it is absorbed by us. Otherwise, either the customer chooses to increase the price of the component that they're buying, or they reach out to their OEM supplier, approved supplier, to sort of reduce the pricing. So it's a pass through pretty much for us, where we only look at plus minus 5%. So that does not, because our major job is value addition, right? We only start our work after we've procured the raw material and then until the finished product. So that is where you see our EBITDA margins, like you rightly said, are a reflection, because we are a company that has an 89% of gross margin, right? I mean,
Hmm.
and if you look at our EBITDA margins also, while we grew, we've consistently focused on our EBITDA margins. So that's why our adjusted EBITDA margin is about 80 crores for last financial year.
Understood. One question, please help us understand. We were talking, I think, before the show. Please help us understand on what was the adjustments done last year from the perspective of any convertible instrument. Because last year there has been a dip in the profit, but appears to be more about your internal adjustments. So help us understand more about that.
Sure, sure. So Piyush, I think we'll have to. So I'll take two steps back and maybe narrate this. I'll have to take about 30 seconds for it. So we raised our first capital round. So in 2019, 2020, we realized that the growth was coming in. The growth that we are able to see, all of these customers put together. So we decided to raise capital at that point in time. Now we had to, because we had 20,000 square meters, we had to buy a larger piece of land. So, but the traditional banks don't fund us for it, right? So we had to go out in the market to raise capital. So we raised the first round with our investor called as DMI Finance. So DMI Finance is a structured credit fund, and they invested about 60 crores in the form of convertible equity in our company. Now we use those proceeds to buy land. Now obviously, if it's a convertible equity, it has an interest component that is higher, and you have to constantly keep paying monthly coupons, etc. And in the second year, calendar year 22, we raised capital from Piramal Alternatives. We realized that we need more capital to grow, and obviously ours is a world where we live in commitment. So when we tell our customers that we'll be building capacity, etc., we have to do it. So while raising capital, we realized that the Ukraine-Russia war came in, the process was getting delayed. So we took Piramal Alternatives and in the form of compulsory convertible debentures of 160 crores. Now, this
Okay.
160 crores was used to give an exit to our existing investor DMI and to
Okay.
fund our growth. Now, if you look at our PAT margin, you would see that this year, even in our RHP, it is on page number 310. So if you
Hmm.
look at this year, there are two broad adjustments. So one was we gave an exit to our existing investor DMI. So there was a one-time redemption cost that came onto the P&L, which was of about roughly 15 crores,
Hmm.
14.7, 14.8 crores. And the other cost was we are paying interest to our convertible, instrument, which is to Piramal Alternative. That is to the tune of 15 crores. So 30
Hmm.
crores roughly is between that, and then there was a foreign currency loss in conversion that we have about 5 to 6 crores. So 36 crores out of our
Okay.
finance cost of 52 crores is a one-time adjustment, right?
Okay.
Now, when you add this back to it, you would see that our adjusted PAT is roughly 45.3 crores, which gives us an adjusted PE of TTM of about 67, 68. So that is the adjustment. Now these convertible instruments are no longer in our books because our investors have both converted to equity. So if you look at the status today, Piramal Alternatives has converted their convertible instrument into equity, and they would be taking an exit in the IPO because they obviously cannot hold any. They cannot hold any equity positions in the mandate of their fund is to not hold equity positions. They would have to be in convertible status, so they would be taking an exit. So if you look at our finance cost for the current quarter, you would see that we will not be paying any interest coupon, or so the normalization of the finance cost will happen. So if you adjust for these two things, which is the redemption, one-time redemption of debentures and coupon payments, and whatever foreign currency loss that we've had, you would see that 52 crores would adjusted PAT would go to about 45.3 crores for last year. So I mean, I hope I was able to explain that. But yeah, and our
Yes.
EBITDA has been pretty consistent, sir. If you look at our EBITDA, we've been doing about 32, 33%. And in a sector where, because you know we have we didn't start our company. I think it's important to note we didn't start this organization doing a 30% EBITDA, right? We started with a 10, 12% like most geographies. So today we are competing with China. Our competition is only outside the world, right? China, Japan, Europe, US. We are beating each of these geographies in pricing while maintaining a 30 to 33% EBITDA. Our competition outside India is working on single digit margins, or low double digit margins, while we have a pricing vacuum that we've created between us and them. We are beating even China in our pricing while
Is it
maintaining
why?
33% EBITDA.
That's very interesting. No, but what's the reason? Is it primarily labor cost? Is it like uh, well, what it could be? Lower capital cost? What is the
No,
reason?
it's not. So, usually it's, see, I think that is the most common conception that, everybody has, that, India has the pricing advantage, or we have the pricing advantage because of labor arbitrage. See, labor quantum in our business is hardly 18 to 20%, right?
Yeah, because
Now,
you're
even
manufacturing high
if
precision components, and that's
no,
usually
no,
automated.
even if we were 30% cheaper, it would only impact by 5, 6%. So that's not the reason, honestly. It's the value addition. See, this is a business of extreme engineering capability, right?
Right,
And
right.
not, so you don't have a standard process of manufacturing it. You need experience, you need continuous improvement, you need lean. So we do about 80 to 89% is value addition for us in our
Okay,
business. So we've been
okay,
able to do that, right? It's about how do you design the product, how do you design every process, right, from raw material cutting to each of these processes that you manufacture, right, until dispatch. Every step of the way, we've optimized it to a level where today we are the most competitive airfoil supplier in the world for land-based
Okay.
turbines.
And
So
that
that's the kind of
definitely
position. While maintaining 30 to 33% EBITDA. I mean, that is, and it should be a proud moment for us,
sure.
because Piyush, no company has been around the world also has been able to break these barriers and compete with these geographies, right? China has been making the world sit down in manufacturing. वो सबको बिठा रहे हैं because they have built huge capacities and nobody has been able to compete with us. And we
Hmm.
have been the last entrant, and today we are beating them in pricing, and our pricing delta is pretty huge, right? That's why we've created the vacuum and we are growing at this rate.
That sounds good, and that also tells in your margins. Perhaps the one small clarity, and then we go actually to the fund usage part here.
Sure.
One small clarity about 27 crores in profit after tax in the first 6 months of the year. When actually, so this 27 crores now doesn't include any hit from the DMI that is already completed in FY23. This is a
So
clean profit after tax, right?
that's correct. That's correct. That's correct.
Okay, okay,
This is
sounds good.
correct, but you
And
still have this also has the so the coupons that we've paid to Piramal until this quarter, right? So
And
it has
how
that
much was
component.
that? How much
So
was
it was
that?
so just give, so I think it should be about 10 to 12 crores.
So that's 10 to 12 CR for the first 6 months of this year, right?
Yeah, yeah. So if you look at that now, this quarter that impact will not be there. See, we pay 10% coupon, on a 160
When
crores that we
when
raised with.
when Piramal converted its into equity, was it in the second quarter?
No, Piramal. So Piramal just converted about 3 days ago, 3 to 4 days ago, because
Understood. So now
so their
now
mandate.
in the next
Yeah. So
6 months,
that.
basically this
So
coupon is not going to come because they
yeah.
are going to take exit in the IPO, which implies
Yeah.
automatically there is going to be an adjusted positive impact
So
for the PAT
our
coming up.
cash, yeah, Piyush, our cost of capital is quite low because we have a foreign currency term loan, right? So we've always in our business enjoyed, capital costs under 7-8% historically, if you look at it. And it's only in the last 2 years that we raised capital for growth, and we did this. But today we do not have anything. So in the first H1, in the H1 that you see, we still have a 11 to 12 crores, roughly around 12 crores of coupons that we've paid towards, and this is after we've paid coupon, right? So
Understood.
you can obviously do the math. So, and this will not be reflected in this quarter for sure. Jan, Feb, March, we are not having any convertible instrument in the company. So I think uh, it
Understood.
should be normalized.
Now let's go into how much funds you're raising,
Yes.
how much it is going into the company, how much going into OFS, out of the what is going in the company, how much
Yeah.
basically for fresh capex. Help us understand that.
Right. Right. So usually I think so we have an issue of 740 crores. Out of this issue, 240 crores is primary and 500 crores is OFS. Now I explained to you that so there are three selling shareholders. We have Piramal Alternatives, we have DMI Finance, and we have a promoter who's so between all of them, they're selling about 500 odd crores. Now Piramal Alternatives, like I told you, and DMI Finance, they cannot hold equity positions in the company, so they have to take an exit as a part of their mandate. So they are selling, and a promoter is also diluting a little bit. So that is the 500 crores of OFS that is happening. And the primary of 240 crores that we're raising is essentially used for, two aspects. One is to repay our debt of about 138 odd crores. And then, capex investment about 60 odd crores, and then some general corporate expenses that we have. But any deployment that we are doing, whether it is to repay debt or to repay, to invest in capex, is used towards growth capital. We are on a so our industries, like you said, are sunrise industries, and these industries have been growing. So we have prepared ourselves for the growth over the last few years. The so today we have 42 43 acres of land where infrastructure is coming up, which is going to add about 8 to 9x capacity, and all of these things have been done keeping the looking at the numbers or the growth that we've seen historically with our customers,
Just
the contracts and
just
these things.
just asking again. Did you say the capacity is going to increase by 8 or 9 times?
Yeah, that's correct. So we today operate out of four manufacturing plants with a
Uh huh.
total square footage of 20,000 square meters that we have. We are adding 1,70,000 square meters.
That's huge. And when is it going to get commissioned?
So the projections that we have in our business until FY25, financial year 25, I think the four plants that we have are going to be good enough for us to cater to our projections. From FY26 onwards, right, the new revenue is going to come in. The incremental revenue between FY25 and FY26 will come out of the new plant, and then so on and so forth.
Okay, understood, understood. And this 60 crore is going to contribute towards that capacity expansion.
Yeah, so we don't need to deploy capital head on in our business. So we want to also optimize the deployment of capital. So
Hmm.
once we've done it, and we will keep, so debt will be repaid for now, and
Sure,
and then as and when we need capital to be deployed in infrastructure and in machines, we will do. See, in our business, the industry is so huge that the demand is not a challenge, right?
I know.
It's only the capacity, how much can we deliver? That's the challenge. So we are trying to just add capacity because the headroom
I
is
have
the
questions.
immense.
Sure, I have two questions.
Yeah,
One question is, what is the average asset turnover you maintain in your company? Like
yeah.
7 times, 8 times. What's the average asset turn?
Yeah. So currently, I'll tell you broadly for the sectors, and then so today, energy industry and the parts that we're making have an asset turn of around 1.3, 1.4, right, in this
Okay,
industry. But the aerospace and oil and gas industry that we've entered about 4 years ago is at an asset turn of 2 to 2.5. So today we
okay.
are at a blended asset turn of 1.4, but you'll see that the business mix for us is changing because of the growth sectors that's there. So, so 2 to 2.5 is the asset turn that we would be looking for the current. So, each of these verticals are on a different growth path. If you look at our historical growth numbers for energy, it's at about 30-35%. Aerospace is growing at about 60-70%, right? Historically, if you look at those numbers. So that would be visible in our asset turns. And it are only poised to grow up as the business mix changes, right?
I think there's a lot of positivity, as you just explained. The sector that should remain on a very buoyant path, and since the entry barriers are high, it definitely actually makes it a very interesting story.
Yeah.
High EBITDA margins, good ROCs, good PAT margins. Now the coupon payments are no longer going to be there. Perhaps the next year full numbers are also going to look much more interesting. So I
Yeah.
think with all of that, perhaps it serves and presents a very interesting story to our viewers, and I'm sure they would have understood and liked it a lot. Vishnuji, thanks a lot for coming on our show and helping us learn about the company. From our side, from our viewers, we wish you all the success for your IPO, and also we'll get in touch with you again when actually the results get announced by you subsequently in the fourth quarter.
Thank you. I think thank you, Piyush ji, for this. This is really good, and I think this is the kind of response that we've also received. We've received such great response, and we are very thankful to the support that we've received from our road shows in Bombay and in Singapore. And I think in about 2 days we should be publishing our anchor book. So I think you'll be able to see that confidence there as well. So thank you so much for this. I had a great time chatting. Looking forward to more such discussions.
Absolutely. And that was Azad Engineering, dear viewers. For now, it's a wrap on the show. Hope you liked it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.